Recording in progress.
Okay, I'm gonna go on. Your quote mark.
I think Austin went to grab something. You might have to you up unless you want to jump on it. Where do you go to grab? It's Eric.
The show must go on.
Do a left and grab. That's so.
He told me to wait. I was like, all right.
And
Good evening, everyone. This is our first official educational event in our new facility, our new office. So thank you for coming. Obviously, we started this invite during timely when the market was full on the market for a few days. Before the market fell apart, Mark Tanner, who is presented today, manages over $10 billion in assets. He still manages over $10 billion in assets. And he can articulate the market conditions, what we see trends, and hopefully give you some good education. Because we as a firm believes the more education you have, the more confidence you have in your plan and what's going on in the world. And hopefully today we'll try to steer you away from the headlines and the news. Because the news is sometimes there to scare you, to sell you. They're not always there to educate you. So today is about education. We're going to go over about 3-5 minutes of different topics. And if you have a question, we'll open up at the end for Q&A. But again, I thank you for being here tonight. Thank you for your business. And hopefully you'll find some good education out of what Mark said. So with that being said, I'll kick it over to Mark, who's going to lead our discussion on the market update.
Well, thanks, Mom. Great to be here. And we've worked with Jordan about 10 years. I think we're looking back. And you might have noticed is dedicated money manager. We just manage money for advisors across the country. So we work with about 1,000 advisors across the country. Jordan and the team here are in the top 1% advisors across the country. So I just wanted to point that out with a firm that's grown a lot in the last few years, and really appreciate the for your good hands. So in the short term, what I think that the market has undergone, you can ask questions at any time, questions any topic. But what we call this environment is the terror tantrum. Market just doesn't understand what policy is and how it relates to the market. Kind of changed, shifted back and forth, and it's come across very quickly. So kind of makes the market a little bit spicy. Even though we have a concern that did talk about tariffs with China as well, I mentioned that on that went. So we do have a little bit of a roadmap. We're kind of in the short term. This chart, I think it's hard to see, but this takes a look at policy uncertainty. And so look at policy uncertainty that includes tariffs and DOGE, as it's called now, any reductions, payments, things like that. Really looking at the problem. But either way, at a macro level, the market's looking at, well, what is government spending going to be? Is it going to cut back a little bit? And how does that impact GDP or overall economy and stock market? So the level of uncertainty has hit a pretty high level that we haven't seen over the last 40 years. So it's consistent almost with COVID from policy standpoint. But that really hasn't been as big of a concern for the market. The market didn't react like it did during COVID. So the market stayed like with about a 10% correction, which is very normal. It's rule of thumb, a decline of 0.5% from recent highs on pullback, or 0.10% on pullback, 10%, negative 20% is market correction, and more than 20% decline is a bear market. So we have a bear market in 2022. So this is the third year of the bull market size. So expectations to be a little bit muted, but that doesn't mean it should be necessarily overall negative. So we just had a normal correction. Went a little bit long in terms of average time between 10% corrections. Get one about every 1.1 year. Here we went almost 3 years without a 100% correction. So now that we got that, the market's going to be assessed and adjusted to some of that uncertainty as well. But keep in mind, when we talk about tariffs and trade, all things aren't equal. And it's not as big maybe as some talk about in terms of the impact of the overall economy. We import about 3.3 trillion. We export about 2 trillion. The gap is the 1.3 trillion in round figures. Our overall economy is 30 trillion size. So the chart, the names are and you can see, but all the way to your right is Mexico. 28% of that economy is based on trade with the U.S. 21% that is no longer there. There is Vietnam as well, which is highly related to the U.S. market as well. All the way down here, the lower less than 5% of China's economy is based on exporting trade. So much smaller than it has been historically, as China's not made a drop. But still, again, it's actually a pretty big deal of what's happening. And as an example, we talk about oil. We do get imports from oil. Canada exports oil to us. 97% of their exports go to the U.S. So it's not just that easy for them to maneuver North America and those relations. So it's pretty big deal for these economies overall. It's a lot less of a concern for the U.S. economy. Now, two of the concerns are basically, well, it causes a rise in inflation, higher prices. Historically, that actually has not been the case with tariffs. They have a short incremental bump just on the initial, but then prices go back in. So it kind of stabilizes. Remember, the way they calculate inflation is kind of year over year. We didn't get a bump up, but we didn't get a steady rise in growth. But the chart shows that 2020 experience in 2021 inflation. So when we shut the economy down, we COVID and then restarted it, what we have is supply and demand imbalance. In other words, demand outstrips supply. That caused inflation. We hadn't really had this situation in decades, a couple of decades. And then in the color here, we show components of inflation. So what really drove that? In order to support goods, that's just the supply of goods. People rushed out and bought. Value and goods supply chain was just not back on. And then the other thing there is energy. Oil prices started. We have some shelter house prices in there. They actually made adjustments, but not directly house prices. Homeowners food and rent. Those are pretty big components. So as we got into 3.4, it's gone with essentially no inflation. Energy market is often with zero inflation. The largest equivalent rent is coming down, and so it'll have a downward pressure on inflation overall. So inflation is not based on, I know that's probably in the headline tariffs, what are those in prices, as well as price stuff, but overall, historically, tariffs did not cause a big inflation problem. Inflation comes from when demand as well as supply. It's kind of where we're at. The oil is at about $70 a barrel. That has been possible. And the house price component seems to really be coming down, just as big a decline. Remember, not prices coming down, just the rate of change. But I'll mention, U.S. economy way to calculate GDP or the economy is essentially consumer expenditures, consumption, plus investment in infrastructure, buildings, plus government spending, plus exports minus imports. The largest component, about 70% of GDP, is personal consumption. That's the big driver of the growth. We have a little bit in government spending as well, it's about 19 to 20%. So we can go, but not as big as consumer spending. Consumer spending will track essentially the employment rate. So we have unemployment below 5%, that's considered maximum employment, anytime we below it. So as long as that stays pretty steady, the consumer remains very resilient, and that's why really during the inflation time of 21, 22, the economy kept going around, kept going along, and didn't enter a recession. The contraction, two negative quarters of economic growth. And so the market sold off when it entered a very on the expectation that there was going to be a recession. And that recession never showed up. And everyone's still looking for a recession. And it's because unemployment stayed very low, which allowed consumer spending. So that's really the key that we're looking at. Is can the consumer remain resilient? There's one rule I say it's global. And it's worth basically 23 out of the last 25 years, which is never bet against the U.S. consumer. They will spend, and they spend, and they spend, and it pretty much works. So that's what we're looking at. And when I say we're not looking at sort of the inflation component, having a reduction in government spending, I'm pretty sure that's what we look for more of a concern. That would just be a drag in the road, not necessarily a recession in the road for. Unless you give some kind of a shock, but it's usually an exogenous shock, not necessarily one that's part of the planning process. On the scene of oil, I want to mention this because the last 15 years has seen a lot of change in oil. The U.S. produces in the U.S. over 22 million barrels per day of oil. We use 20 million barrels per day. We actually have a surplus of oil in the U.S. We are a net exporter of our oil. That's more than Saudi Arabia and Russia combined. That's how big of a producer we are. That's happened really in the last 15 years. So dramatic, where Saudi Arabia and Russia have basically stagnated around 10 million barrels per day. China, Canada has grown about 5. But you may say, or you mentioned earlier, that when we import oil from Canada, why would we import it? You produce more than we consume. The issue is 70% of our refining capacity, when you take that oil, maybe gasoline, jet, is based on refining heavy crude oil. We produce light sweet crude oil in the U.S. So the mismatch is basically in our refining capacity, not our production of oil. So that's what needs to adjust. We haven't really built up our refining capacity, but that's the interesting part about oil. They say that we couldn't self-sufficient oil, so then why would we import it, even though we produce more than we consume? So it's an interesting issue, and it's geopolitical ramifications, so where focuses which will relate to semiconductors. Semiconductors are in the 21st century what oil was in the 20th century. It powers the modern. Semiconductors are those little chips. Silicon wafers, basically integrated circuits with transistors on them. And they're in every modern device that you have. The average car has 1,500 semiconductors. I don't remember during COVID, they had all those cars signed up in lines. We have them, we just have the semiconductors there. That's one of the important semiconductors. For advanced cars, we have 4,000 semiconductors. This is a major, major. So in the US, does anyone know the top 3 US companies by the size of the company? Give me Apple, Microsoft. Anybody know the third? NVIDIA. NVIDIA is a semiconductor. It is worth $2.5 to $3 trillion depending on market, mass, and company. So when I say those 3 are what? 3 trillion in size, market caps. Nike is 100 billion. Disney is about 140 billion. To give you scale of how large these companies. Down 200 billion. They're massive. These massive companies. They're bigger than economies. Just on themselves. So NVIDIA, just saying, you might not have heard that it's really on the scene as a major designer of semiconductors. So in the US, what happens is we have the most advanced semiconductor engineers. We have Sadiq here at the PhD level, designed this chip that has some of the functions to it to allow the cell phone to work, to allow rain that goes into your windshield and then wipes off. That's a semiconductor. And what they do, different cosmets, all semiconductors designed to do different things. But we design these semiconductors in the US. We don't really manufacture them that much. We send them to the foundry group that actually physically manufactures the semiconductor. It is a very complex supply chain, very sophisticated manufacturing. And so you can't just put up a factory and it'll take years to train people. Does anyone know who the largest? It's either the name of the firm or the country where the majority of our advanced semiconductors. Very good. It's a very advanced class. Taiwan, that's correct. The company is Taiwan Semiconductor. They just committed to building in the US and in the US. That is a strategic importance that we have domestic production of semiconductors. It's not going to happen overnight. It's going to take years. When you're talking about billions of dollars flowing into this building semiconductors. Does anyone know why Taiwan ended up being the center of semiconductor manufacturing? In the 80s, the young upstarts in Silicon Valley that saw this vision said, well, wait a minute, we have this technology that we're starting to get beat up. Yeah. So we needed to find out, it sound like quite well. So we needed to find another area. So we needed to find another area. Bad semi, that's right. It would be bad battery technology too, it's important. But we needed another producer that could help us compete in Japan, essentially, and we ended up with Taiwan. And so over years, we started to develop the business in Taiwan, and there was a great relationship. But now, of course, you hear about different geopolitical risks around Taiwan, why China wants to be there. And so instead of all the talk about the Middle East around oil, we're talking about Taiwan. So that's how it's shaped geopolitical risks. Well, that's not good. Why we hear about investing in the US is strategically important. Semiconductors are based on Moore's law. Gordon Moore, one of the founders of Intel, basically said that the strength of the semiconductor will double every 2 years. The amount of transistors on the circuit and so forth, every 2 years. That's still basically the industry standard. And it's held pretty true since the 60s when he said it. So that's the standard in the industry that this passing keeps doubling. You know, if you have an iPhone 6, it's probably not starting to keep up with everything that's necessary. So it's old compared, and that was only 20 years back, and it was very advanced. Sure.
So, I know that Intel is building these plans and Micron plans. Is it still like a 3-year manufacturing process to get them planned?
I would say yes. So they're putting more money at this up. So, and but you have to get the workers trained as well. I think it's a big gap. Right? So production will start, but it's not going to be at that big scale for a while. So that's why I said this is a 10-year process. You can't think this is overnight. So we're going to try to get there as best we can. In Taiwan, it's kind of like it's part of the national heritage in a sense. Yes, if something goes down with the line, you're gonna call it midnight and go into the office. Not questioning it. It has to get done. And they have a ton of demand. In fact, part of the reason why the autos were sitting there was that the auto companies all said when we shut down COVID, they called them and said, we don't need them for right now. So what did they do? They said, well, fine, well, manufacturers will stop making your chips, we'll make these chips, and kept running, and then they had to go back and get them. So yeah, it's gonna take time. It's not an overnight build a factory. You gotta train folks as well, and workers as well. It's skilled manufacturing. And so if you look at the breakdown, you have heavy communications, as you can expect, iPhone, computers. So what do semiconductors do? They basically process and store data. That's what they're doing. So processing, computers thinking or saving. That's basically what semiconductors do, process and store data. But I mentioned automobiles, they're in industry, and then even in your consumer electronics, your coffee machine probably has Wi-Fi enabled. They have your oven does, and so there's semiconductors and everything. So that's how wide it is. What has happened over the last 2 to 3 years, really coming out of that 2020 and 2022, and then what's led the market has been this excitement around the third business area for semiconductors. The first area is digital, so that's the laptops, computers, analog, that's the car, washer, dryer, whatever it has, semiconductors in it. And then AI. Everybody hear of AI, artificial intelligence? NVIDIA, the largest semiconductor player, they have been the leader in the most advanced semiconductor chips needed to power AI. A lot of processing power and data. So that's why they took the lead. Others are kind of moving in that direction, but they're clearly the leader in the chip design. It's necessary to power artificial intelligence. And that's why these large companies, whether it's Google or Tesla, demand these chips from NVIDIA. That's what's been driving the market, this excitement around AI. Right up until about kind of the tariffs took over some of that headline risk that comes in the market. But we're not the only economy that has realized semiconductors are important to see. The colors just show each of these countries have been putting massive stimulus into development of semiconductors. So by far, you might hear that NVIDIA is banned from selling their chips in China, for example. There's flat market in China to get those chips and so forth, because we want the most advanced chips because they'll be part of military applications and so forth and so on. So this is a battle for the future investment and having them semiconductors. So those are all the countries really involved in this so far. But a word on artificial intelligence, because I think that's going to help propel the second half of the 2020s, which is at first, artificial intelligence and the markets reflected this, has leaned towards the large cap tech stocks that have the most data. And they can use them to produce, they use all this data to produce large language models, LLMs, as it's called. So that's where if you type into any of these things, a question or help me with my resume or something, they'll come back to you, not just in links like Google does, they'll give you a link to a resume firm. They'll come back conversationally and write a full paragraph to you. And you can put in data and it could write a whole resume for you. And you look at it and say, wow, that's pretty good. I wish I wrote that. So it's becoming more conversational, more applicable. That's the large language models. But then we'll go beyond that. We'll have more applications for enterprises and so forth. So this is early stages of what's happening. You'll hear LLMs, but it's artificial intelligence. Behind the scenes, why I say this could be really, it's not just AI or just tech companies, it's because in order to run artificial intelligence, you need more energy, more power to these big data centers. And if you talk to any of these conference calls for these large tech companies, and they talk about they're building data centers in different locations throughout the country. They're in Virginia, even though these guys are located in California. They say, well, we can't work with the utilities in California to get this much power. So they're locating these centers near areas where they can find power transmission. So the expectation or kind of the estimates show a major increase in energy consumption necessary. So this is a major play. So it's all types of energy. Right now, the U.S. solar and wind actually has taken over coal as a producer. So about 15% of our energy comes from coal, 17% from solar and wind. But the issue is not just energy generation. It's how do you get that energy out to where it needs to be. So the transportation of that energy as well. You could lose some, you can go out. This is a major upgrade in electrification of the entire grid. And it's not going to be overnight. We've spent 300 to 400 billion on this. That's going to go to 1.2 trillion probably annually for the next several years to electrify, upgrade the grid overall, and to help sustain what's necessary for kind of this AI and how you use AI to run those. So the big data centers, big computers are thinking and processing a lot of data. And that's where AI has almost like an energy, if you will, value chain. Where you have an upstream, which would be the utilities. Then you go to a midstream. Those are kind of the power transition of the line and so forth, and the technologies that come with that. So big advancements in technologies of how much you can carry the lines and so forth. And the generator companies. And then all the way downstream, which is at these data centers. And that's where you have the processors, the chips. You may hear when it's semiconductors, CPUs, that's just computer processing, and then you have GPUs, graphics processing. So all these different chips that are in these data centers. So it's a whole value chain, and it's affecting the entire economy. And that's why I say it can drive the economy overall. So if you're thinking about AI, the initial leaders are big cap tech, then you look behind the scenes, and part of this got captured last year where we had a nice run of utilities because the market all of a sudden realized that, wait a minute, these guys aren't just the old utilities. You're going to need these massively critical, and they're going to need to play a different role or grow, in other words, to meet these demands. You might hear nuclear as well, somewhat of a nuclear comeback, but it's not the big nuclear power plants, it's the small modular reactors. And so that's coming online as well. So smaller capacity, specific purposes. So it's kind of an exciting time from that standpoint as well. So just to jump into 2025 and give kind of a few kind of remarks on the market. One of the issues with this market that you have to understand when we're thinking about it too, is that the top 10 stocks in the markets are most Apple, Microsoft, NVIDIA, and so forth, represent about 38% of the S&P 500. So just 10 stocks are more than a third of the entire index. That's how big these companies are. So massive. That's much bigger of a concentration in those stocks than the peak in 2000. Or 73, 74, you're gonna have the Nifty 50 in kind of these top stocks as well. So that's a high level of concentration risk in those stocks overall. So those stocks, and movement of those stocks can impact the overall index at a pretty high level, and may not be telling the entire story of the market. In other words, a lot of those energy companies, utilities companies, sometimes get missed the value that they might be, and they could be growing, they might not know it, but some of these large cap techs are declining. And it's just because they are so big that we have to be mindful. It's not that they're not going to be important. It's from a market perspective that they're so big that maybe the changes in those stocks will impact the market for the next several years. So what does that mean? This year, market's negative year to date, just a couple of percent, not terrible. Nevertheless, nobody likes that, right? Look at the Mag 7, so the 7 largest of the 10. So it's called the Mag 7, if you've heard that term. So that's Meta, which is Facebook, Amazon, Microsoft, Apple, and so forth. They're down as a group, this blue line, about 12%. The rest of the market is down about 1%. So what dropped the market overall? It was just concentrated in the large cap tech stocks. If you're to look at value stocks as opposed to growth stocks, tech is in growth stocks and value stocks, they're up out here. Traditional dividend paying stocks, kind of blue chip dividend paying stocks, they're up out the year as well. The overall market is down. So that's the difference that we're looking at and say, well, wait a minute, these can have heightened risk with just a broad index or growth stocks, but the rest of the market may be doing fine. It was somewhat ignored for the last 2 years, and now we've gotten overly concentrated in these stocks overall. So that's really telling you the story of what's happening behind the scenes in terms of the market landscape. And what's kind of important to make sure you think through the asset allocation of the portfolio, you're not just concentrating on those stocks, but the opportunities can be elsewhere at this point. That doesn't mean that you can't get a balance or good run in these stocks. It's just mindful of how markets work. Speaking of going back to Trump's first term, when the tariffs and taxes, the policy. In orange there is 2018 when he had a tariff focus on China. And so what the market did was, when the orange line is going down, it actually says value stocks or defensive stocks are outperforming growth stocks. So when there's a tariff focus, it would favor value over growth. Dividend payers, conservative companies over the growth stocks. That's exactly what we're seeing in the marketplace since tariff focus has been in the front part of the administration so far. In 2017, there was a tax focus. And so what happened, growth stocks outperform value stocks. So if he switches, or the administration switches from tariffs to taxes, we expect the same type of turn would happen. And it makes sense if you think through, okay, that makes sense. But that's what's happening in the market and how policy shift. Tariffs somewhat man-made. It's not kind of a manifestation of the economy kind of getting overly concentrated or misallocation of capital, but they can turn off quick. Or you can just as he's reversed them from time to time. So that can change pretty quickly. So we keep this really close to understand how the market's working. And if it follows this track, it tells us this is a pretty good path to follow. We usually do a cycle analysis every year to take a look at, well, how do we expect the year to go based on historical averages? And we use presidential cycles. We found those to be actually line up with the 4-year. Traditionally, there's a 4-year economic cycle. We found that the economic cycle lines up pretty well with the presidential cycle these days. It got closer and closer as we went from, if you go to 1900 to 1950, it kind of follows the agrarian economy, moving to an industrial. But then as you get into the 50s and beyond, it's kind of lined up with the presidential cycle, meaning the first year of the presidential cycle, you could have a top year, but then it starts to fade, and the second year is usually the worst year. So if you think of Biden's administration, the 22 was the second year, that was the worst year. The third year of the presidential cycle is usually a good year. And the fourth year, the election year, is actually a resilient year. Everyone's worried about the election, market just kind of keeps going and divides everybody. And that's exactly what happened in the last 22, 23, 24, kind of follow that path. There's just a guide to let us know in this cycle, the markets kind of tell you that, history would tell you that, okay, kind of choppy start of the year, March, April, but then it oversold, and then you have some type of spring, summer rally, and then it starts to fade out from there. So overall, that tells us not to be overly bearish. Just because we have a sell-off right here, markets hit what we call oversold conditions. And so you could have a rebound rally that could take you out into the spring, summer. This could always change if you look for deviations from that. But this is a pretty good base case where maybe you peak sometime mid-year, and the market kind of churns sideways for the remainder of the year. So we'll be on the lookout to see what that looks like. But it definitely doesn't tell us that it's an outright bearish, that we should all of a sudden turn bearish on the overall markets. So looking at, whether you're looking at it from a fundamental perspective, a policy perspective, or a historical perspective, we'd still say probably at this point, lean bullish, that maybe we'll start to see some bottoming action, and we're seeing some bottoming action right now, and if the market can hold, it'll start to recover. And it'll be led by those big cap tech stocks because they sold off the most. And earnings are still strong with those companies. But a fun one, speaking of history, is that years that end in 5, going all the way back to 1895, there's only been one that's been negative. That was 2015 with a negative 0.7. So again, try to leave you with some positive news that years that end in 5 historically have been positive. So I'll hang my hat on that and say, I like that. Those are good numbers. So I'll stop right there and open up for questions. And if Jordan wants to come up, it's welcome, obviously, to join me as well. But thank you very much for coming and for listening as well when I talk about semiconductors.
Perfect.
There's most of the videos, manufacturing capacity, it's not long.
It is, yeah. Taiwan Semi is the most advanced manufacturer. So Samsung does some, we have some domestic, but it's nowhere at that advanced level for the AI chips, those advanced chips. Correct. Yes, sir.
Another question. Considering the escalating energy demands created by AI and other technology leaps, what do you take on alternative energy, nuclear, future of those sorts of energy sources in America?
Yeah, so you may have heard of some expense or some plan to spend more and more money by these big tech companies, building out their own energy infrastructure and resources. It's not small money, it's very big money when you think about capital expenditures in the overall economy. So nuclear is in the play, there's a nuclear renaissance for sure. But as I mentioned, it'd be the small modular reactors is what I'd be looking at. There's also a few technologies helping that cause along the way. The one interesting part of Trump's first term and Biden's term was that the narrative was that Trump would be negative for alternative energy, and Biden would be positive. Just the opposite happens. Alternative energy for stocks very well under Trump's administration and did poorly under Biden's administration. So the market, you don't have to, be logical or things like that. It just works differently. So in that sense, I think it would actually be somewhat favorable, interestingly enough, for alternative, especially since they've sold off. There's going to be a demand, and there is a race for energy. China's building as well. They want the energy fast for their economy, and they're competing there. It's mostly domestic type, and those sources domestically are don't have the tariff risk, if you will, associated with them.
For you guys, any other questions?
I actually, so the question was the trend in interest rates. I actually think that if inflation is actually coming down, interest rates are actually coming down as well. So it's not a spike scenario where rates are going much higher. We think that we're range bound to lower. So I think the Federal Reserve, who sets interest rate policy. Anyone know the chairman of the Federal Reserve? Jerome. Very good. Very good, yes. You'd be surprised, I go, no, the markets, so anyway, the Federal Reserve sets interest rate policy, they raise or lower interest rates. They raise interest rates if there's inflation, because they want to slow down growth. They reduce interest rates if they want to encourage lending and borrowing. They have a dual mandate, which is to have policies that promote full employment. So if there's high unemployment, they lower interest rates, which is the reverse. But the second part of the dual mandate is to maintain stable prices, which generally means around 2% inflation rate. So if inflation's higher than that, they raise rates to bring it down, vice versa. I think the expectation is short-term rates are about 4.25. The expectation is for 2 rate cuts, which is 0.25% down to 3.75%. And that is right at 80-year average. So I would tell you that I think interest rates, regardless of kind of everyone talking about the change in interest rates earlier this year or late last year, interest rates look like they're going to be right at the 80-year average. So not much change from these levels, slightly lower on the short end, slightly elevated on the longer end, but that's fine.
What about specifically the mortgage rates? Back to the 5 and 7 and 7.
For the what? Mortgage rates. Yeah, I do, unless I'm not sure. Yeah, correct. So in the housing market, rates have not necessarily slowed prices, they just slowed turnover transactions. So we had, it's not like in 2008. 2008, we had demand out the window, we had way overboard, and everyone was over leveraged, and the banks. We're about 2 million homes under supply. So that'll keep upward pressure a little bit on house prices for even though transactions have slowed down. And part of that is because, yes, a lot of the mortgages are at that fixed rate from earlier. And you'd say a lot of people aren't moving because they have that fixed rate. That's an asset. You can't move. They have you stuck. So we don't expect too much change in mortgage rates either. Yep.
With, there's a lot of unrest in the world, obviously. What effect would escalation have in general on the market, and if for whatever reason the United States would be more active?
So historically, and you could even go back to when Russia invaded Ukraine originally. So everyone kind of got freaked out, and it turned out that for the markets wasn't as big a didn't impact the markets as much, surprisingly. So these crisis events don't have a big negative lasting impact, like external, unless it's a financial related kind of crisis event. They don't have this big of impact. So you can say it'll kind of result, like the market will sell off initially for about a month and kind of recover after that, even though everyone's kind of lost interest that they don't, say, oh, the market's done for, and come back, and then it'll assess. Fiscal spending would expand if the U.S. starts to increase its involvement. So I think you have some relationships would change, but on the economy overall, I don't think that would have, and the markets overall, as big of an impact as maybe you think it would have, even if we did get involved. Yep.
Question regarding tariffs and tariffs will be expected. Expect prices to go up for consumers. Then
Mildly, historically, so the history of, and remember Trump added on 2018, China, and there was no inflation bump. At that time, what has happened though, our trade deficit with China actually has shrunk, while our trade deficits with other economies have grown. So that relationship did change, and China's economy reoriented, as I mentioned, it's a smaller part than it was. So the tariffs would have maybe a small bump when it initially is, but then there's not a repeated, so inflation is kind of year over year. So in other words, that's a one time, maybe price lifts, but then it's not a repeated inflation increase. So it would just stabilize from there. And historically, tariffs actually have had a mildly deflationary impact on prices. Because consumers will pull back somewhat or say, all right, that's, purchasing. So it's not as big of an inflation concern as maybe sometimes the headline puts out there that, oh, you're gonna pay so much more. Well, then it might be a bump, but after that, it doesn't show up like inflation figures. Yep.
With a graph with, exports indicated Mexico.
Vietnam.
37% Vietnam. What products?
Oh, yeah, so what happened was,
That's not.
China,
T-shirts.
yes, yes. So some of the, China's not going down without fight, they can relocate.
Yeah.
So some of those companies relocate and worked around the tariff, but Vietnam was a low cost producer. So a couple of those other areas, Bangladesh, but
Yeah.
Vietnam was a big one where they were a low cost producer, where as China's economy has grown, their average incomes have grown as well. So it's not as much the low cost producer as Vietnam was. In Canada's case, it's petroleum products, oil. In Mexico's, it's transportation and services, they're big ones. Both of those actually don't have as big of a price change based on the tariffs. Agricultural products have a bigger role, but the two big ones actually aren't as sensitive to tariffs. Yep.
Second question would be, in the past, always big data centers, Amazon, they've always built like in Finland, Sweden, because they had a cool building on it, which was big energy. But now they're looking at power, they're looking at building their own plants. Would that be something to look into, or is that way further along by way of the market?
No, I think that's still in play.
It's still,
It's still in play. So that capital expenditure, that spending, it's set to continue for several years. So I think they're logical beneficiaries and coming up cooling. You have cooling as it gets hot. And you think that it's just like a fan on my laptop. Well, no, it's major. How do you cool, a building like this that's burning at hundreds of degrees in certain parts. So that's the benefits too. They're part of the value chain. I didn't mention that, but it's in cooling. It's cooling. And how do you cool this down and so that's for sure part of what they're building out. So capital expenditures are set to continue. Planning set to continue. Yeah, part of it is that they, from COVID, want some domestic production. Oh, sorry, it was tariffs on pharmaceuticals. Tariffs on, I think that's it's almost everything that he's saying, which is it's looking for something as a trade-off before he peels them off. In other words, he'll use it as a policy tool until he gets something, then he takes it off and then puts it on. So we need domestic production of pharmaceuticals, whether that's the end goal or not. COVID taught us that. If you've read anything about the pharmaceuticals, they'll come from India, for example, that don't have anywhere near the oversight that the US does. So we really demonstrate this.
inspected, sure, they're following their. There's anyone in the department any longer. There's anyone in the department any longer.
There's still folks, they just don't. And now I lost track of what I was saying, so I just.
No, but I would say just to hit on that, which is, we just don't know all the impacts at this stage, so it's somewhat,
Sorry, they are saying, or he is saying that it's not going to affect the end consumer, and I disagree, because a lot of those products that are coming from Ireland and China and so different from China and India are generic. And how could that not impact the average consumer? Because everybody is going to a generic, or people on healthcare are going to generic. I don't see how it's not going to affect.
yeah. I don't think anyone can definitively say what exactly, that when you get into microeconomics like that, how exactly it's play out. Where supply are going to find supplies elsewhere that's not impacted by the tariff. You can't just adjust that quickly.
Well, and to make them here, we still need raw materials. Don't make a lot of this.
It's a complex issue for sure with the tariffs, like with Mexico. And even Canada, just a little lesser, they're intermediate goods, so they can go back and forth, then where it's at. I know that recently you just mentioned that. It's on final goods, but nevertheless, yeah. Yep. Oh, Kurt, you got a question after this?
I was curious with the AI and machine learning and data algorithms and hear about global bias and things like that. How are those tools changing how your team does its job, basically stops?
Yeah, a lot of the industry is based on, and has been on quantitative statistics and methods. So for the most part, it's very similar to what AI would bring in for the stock selection, which is you're basically putting in data, economic data, you're putting in. So what's the monetary environment? And you put in all that data and we tell you, okay, that's good, bad, same idea of any other spreadsheet. You got to make a good, bad. And so you take a lot of data, and this is what AI calls it. You take even more data to input, these massive reams of outputs. I would say it's not going to change as much thing in how markets react. Markets, whether you go back 100 years to today, markets are very similar. The level of volatility, even though it always seems like it's more, same back then. The same amount of volatility was very, very similar. Just using different technology and some things speed up. So, because everyone's got the same data, and then every so often, sentiment overwhelms the market where everybody feels like they have to sell, or everybody feels like they have to buy. But that's been in the markets for a while. These quantitative. Yeah. Yes. Oh, for sure. Incorrect. I do not think that it's going to take away jobs in that. In other words, it's going to improve the productivity of the employee. Now, we have that at fingertips, we can do more with it. So if you look at robotics, Amazon, for example, they've added robots and they've added people at the same clip. It didn't replace people. Now, it could replace certain jobs, but that's normal in an economy. You go back, the jobs of today aren't the jobs of 50 years ago, 40 years ago, 30 years ago. And the jobs in 10 years would be a little bit different.
I just build on part of the large language model that we're subbing on means that it's getting input from all different sources, whether they're right or wrong. So they do need that and the factor, that human factor, and the double check and verify that information is getting out. Well, first they verify that what they're asking is the right way to ask it. And then they have to verify to the out to ensure it's accurate.
Yes,
Still need that check and balance.
yeah, that'll be a whole new area of employment essentially. Understanding the models, the application of the models, running the models.
See, the one thing about AI, I agree, that it's still in a infancy. And these corporations are going to huge, development to prove how these are done better than master, et cetera. And one of the industries that can really benefit is medical research, because of the thousands of computations that could occur within minutes versus months of research. So it's, so they really see that as a huge advance. But again, you got to train the model to see what's right and wrong.
Correct. Yeah, I don't know if you guys remember the name Siebel Systems.
Yes.
Yeah, Tom Siebel, he talks about that. So he created a company. He sold Siebel Systems to Oracle, which is Larry Ellison. And as the saying goes, what's the difference between God and Larry Ellison? God doesn't think it's Larry Ellison. But Tom Siebel is still around. About 10, 15 years ago, he started the AI company. And they've been working, plugging away, trying to figure out what this was as an application layer. And he thinks that that's the medical area. It's one of the areas that he thinks there's a lot of interesting work there.
It's already speaking to diverse concerns, speaking to what their patient records, and finding tumors that interact with them. So it's really, yes.
You guys thought AI was going to take over.
One last question, Brandon.
What companies start? There's like public parents that it's like it's like looking around those spots. So what happens to start money? This investment is
Yeah, I called it a tariff tantrum. So a few years back, maybe 10 years now, there was something called a taper tantrum, where the market kind of just had a fit, not knowing what at the time, what the Fed was going to do, which was basically kind of turn the spigots off, tighten monetary policy. And then it kind of relieved itself. It wasn't a full-blown crisis. This is kind of that. Okay, is there reciprocal and so forth? It would just be a drag on GDP growth. That in and of itself is not necessarily enough to put you into a recession. But it could be a drag on growth.
what's the case? We can't do the forecast. We start trying to do it.
Yeah, so,
That's going to affect their bottom line.
yes, some will, but in aggregate, from a macro perspective, it's probably not enough to change the EPS or the overall earnings of the overall market. But some, yeah, of course, some companies will be more impacted than others. What I would say is that all of a sudden, Europe's fiscal spending has increased. And so that market has actually kind of come alive a little bit. We'll see if that'll stay, but that's kind of what's happened. It's just been a shake up in global markets. Some have encouraged spending, actually been beneficiaries.
What was the result of last year?
Well, yeah, so that's 2018 where would be probably closest to Trump and China. And there was a minor impact. We didn't notice that there was no real inflation. What essentially happened was that China started to reorient. They placed some plants in other economies. We sourced from some other low cost producers. So it wasn't as big, and so it was very mild on the market per se. did have a sell-off in 2018, somewhat similar to this one, where we're sharp, and then as everyone got their arms around it, got comfortable with it.
There was a tariff war back in the 1920s, in which U.S. went after Europe, raised tariffs. Europe came back, raised tariffs, and back it was out of control. Many months. You go back and read it's pretty interesting. Because it's all. But it didn't lead to the depression, I'm not saying that, but it led to the Nancy's war and Europe.
Yeah, refer to Sioux Hollow.
Yeah.
Yeah, at that time, our trade was about 2% of our GDP. It was a different market at that time, but it's an interesting time in history. So some economists say it caused the depression, and that's not accurate. So, I'm sorry.
Now getting into detail. What I'm getting from you is that your analysis is not pretty good. It's not real full advantage.
Yes. Well said. I think I'm right. Well, Jordan, why don't you come back up? Thank you guys so much.
Investment advisors on a monthly basis to kind of keep up to date with what's going on. So if you have questions on your specific portfolio, talk to your advisor. Obviously, we don't just do risk investments, we do no risk investments, but it's about a plan, right? We don't want to just put things blindly in the market or blindly in investments, but have a plan that accomplishes your goals. Because just because the market might be okay at 150 year, the market cycle, doesn't mean that you can tolerate the volatility. So we want to educate so you get confidence. You can make wise decisions and sleep good at night and you can peace of mind. So today we had a little education in the markets. We do anticipate the tax law changing in 2025. We don't know when that date will occur. When that does occur, Keith, who's recording a video as we speak for our tax prep, he will be presenting on the new updated tax laws and kind of keeping the loop how it changed, how it affects you, and what we can plan for in the future. We also have more events coming on this year. Pencil in May 24th in your calendar. You have not got an invite on that, but please pencil that in. It's a Saturday. We were not going to ruin the surprise, but stay tuned on that. Also, tax day, what else would you want to do but swing at a golf ball? Right around the corner, we have the golf dome that you're all invited to swing back at the IRS, see off on tax day. We'll have pizza, we'll have unlimited golf range, we'll have private instructors walking around just to give you some guidance on the golf, because summer's around the corner. And if you love golf, come. If you don't love golf, come to the food, okay, and have a good time. But either way, it'll be a great time. Hopefully you enjoyed this educational experience. We want to do more of these. It's our first kind of trial in this office. We want to do more and more. So give us your feedback. If you have some topics that you want us to discuss, let us know. We take that seriously and we'll discuss that in the future. Again, we encourage us to educate you, our clients, but also feel free to bring your friends. The more people we can educate, the more people we can help, and the more people we can provide value to. So thank you for your time this evening. It's not over. We still got lots of desserts in the back of the kitchen. So bring some home if you can't eat it here. Enjoy. We'll mingle for a little bit. Check out the kitchen. Thank you for coming. Thank you.
I'll take that. My coffee. Yeah, it was weird. Then I gave it mine and it went out. So go figure. I don't know, like that.